Imagine walking down your street, on a totally normal afternoon.
Right.
And on your left, there's a massive five-alarm fire raging. I mean, plumes of black smoke billowing into the sky, sirens blaring, just utter chaos.
A total disaster.
Exactly. But then you look to your right, and there is a huge neighborhood block party in full swing. People are popping champagne, throwing confetti, just cheering like there's no tomorrow.
Yeah, completely disconnected reality.
It's totally binary, and yet it's happening on the exact same street. And that bizarre disconnect, well, it isn't a hypothetical. It is the exact blueprint of the global economy on April 30, 2026.
It really is.
Because while Main Street is out there choking on the worst consumer sentiment since the Truman administration, Wall Street just threw a historic artificial intelligence block party.
Oh, absolutely historic.
So today, we are tearing into a massive stack of market tape, some incredibly dense Federal Reserve transcripts, and a bunch of geopolitical synthesis reports from this single historic day. The mission for this deep dive is to help you make sense of how these two realities are coexisting and, frankly, which one is going to break first.
Because it is the ultimate paradox. I mean, you have the S&P 500 crossing the 7,200 milestone.
Wow.
Yeah, finishing the month of April up 10.4%, and the tech-heavy NASDAQ jumped an astonishing 15.3%.
That's a massive jump for 1 month.
It's huge. And the Dow Jones Industrial Average, it didn't just drift higher. It surged 790 points on the final day of the month alone to close at 49,652.
Just barely shy of 50,000.
Right. So this is Wall Street closing out its strongest month since November 2020.
Okay, let's unpack this, because when you look at these staggering numbers from the April market closes, it's so easy to just assume this is, another chapter in the whole software story.
Yeah, the usual suspects.
Right. But I'm looking at the earnings data here. And the biggest catalyst driving this rally isn't some cloud platform or a coding startup. It's Caterpillar.
Which catches a lot of people off guard.
Completely. But honestly, it makes perfect sense when you think about the thermodynamics of what we're actually building. We are so conditioned to think of the cloud as this invisible, ephemeral code. But you're saying the cloud actually looks like a giant diesel-chugging generator.
That is exactly what it looks like. And to understand why the market is acting this way, we have to look past the software and look at the heavy machinery. We're moving from the software phase of AI to the absolute industrialization of AI.
So Caterpillar is literally building the AI infrastructure.
Yes. When Caterpillar's stock surged nearly 10% on April 30th, it was on the back of this massive 22% revenue growth in their first quarter. And that was driven largely by their power equipment business. You mentioned thermodynamics, and that is exactly what Wall Street is pricing in right now. AI has transitioned from, people querying chatbots on their phones to this structural, incredibly energy-intensive physical build-out.
Right, because an AI data center isn't just a warehouse full of servers.
Not at all.
It's a facility that draws tens, sometimes hundreds of megawatts of continuous power.
Yep.
And the chips themselves, these advanced GPUs, they run incredibly hot. You can't just plug them into the local municipal grid and cool them with a few ceiling fans.
No, they would literally melt down. You need dedicated power substations, massive diesel or natural gas backup generators just in case the grid blips, and this incredibly sophisticated liquid cooling infrastructure.
So the physical constraints of the cloud, the land, the water for cooling, the electricity, they are now just as critical as the chips themselves.
And frankly, just as scarce. That's why an industrial stalwart like Caterpillar is suddenly trading like an AI stock. They provide the heavy physical machinery required to keep these AI servers running.
Wait, isn't AI supposed to make things more efficient and less reliant on the physical world?
You would think so, right?
Yeah.
But the reality is that creating that efficiency requires a massive upfront expenditure of physical energy and materials. And not all tech companies are navigating this physical reality the same way.
Right. Looking at the big tech earnings from this same week, there is a massive fracture in how investors are treating these companies.
Oh, a total split.
It's definitely not a rising tide lifting all boats anymore. It looks like a high-stakes game of chicken over capital expenditures.
Yeah, analysts are calling it the CapEx divide. Investors are intensely scrutinizing the staggering physical costs of this AI arms race.
Meaning they're checking the receipts.
Exactly. They are ruthlessly separating the companies that can prove immediate bottom-line optimization from the companies that are basically operating with a spend now, profit later mentality.
Let's look at Alphabet, Google's parent company, as the prime example of the former. Their stock rallied 10% because their profits nearly doubled analyst estimates.
which is incredible at that scale.
Yeah, and Sundar Pichai was very explicit on the call. He said AI is lighting up every part of the business, particularly in search and YouTube optimization.
Right, they are optimizing existing revenue streams.
They are essentially installing better, more efficient wiring in skyscrapers that are already fully occupied with paying tenants. They proved the return on investment.
They absolutely did.
But then you look at Meta. Meta slumped 9%.
Yeah, that was a brutal reaction.
At what point does the infrastructure cost outweigh the software margins? I mean, are investors punishing Meta just for the sheer price tag, or because they haven't proven that AI revenue loop yet?
It's really the combination of both. It's the sheer scale of the price tag combined with the timeline for returns. Meta raised its 2026 capital expenditure guidance to an eye-watering range of $125 billion to $145 billion.
That is just an unfathomable amount of money.
It really is. To use your skyscraper metaphor, Meta is building a $145 billion power plant and a whole new city district before the area has even been zoned for housing. They're just hoping the citizens will arrive 5 years from now. And investors looked at that projected hardware spending and panicked about shrinking margins.
And Microsoft took a hit too, right?
Yeah, Microsoft took a similar 5% hit. They projected their calendar year 2026 capex at $190 billion.
$190 billion.
Yeah, citing higher component pricing across the board. The costs are just spiraling.
And then there's Amazon, which seems to be playing an entirely different game altogether.
Oh, Amazon is fascinating right now.
Their cloud division, AWS, saw sales jump 28%. But the truly wild number is their internal chips business.
Right.
They reported that their proprietary custom silicon division has topped a $20 billion revenue run rate.
That's internal chips, not even NVIDIA.
Exactly. Plus, they posted a $16.8 billion pre-tax gain from their investment in Anthropic. They are clearly winning the AI software and investment game.
But look at their physical spend.
Yeah, their property and equipment purchases surged by $59.3 billion year over year, almost $60 billion in physical stuff. Land, concrete, servers, cables. Like we said, the invisible cloud is incredibly heavy.
It is the heaviest infrastructure project in modern corporate history. And what the hyperscalers, Amazon, Microsoft, Google, Meta, what they are realizing is that controlling the back-end server farms is really only half the battle.
Because eventually, all that massive computational power has to be delivered to a human being.
Exactly.
It has to be channeled through a physical device, which brings us to the ultimate consumer endpoint. Because while the hyperscalers are out there fighting this massive ground war over power grids and server farms, the most valuable consumer tech company in the world just dropped a massive strategic bombshell.
Apple.
Apple. They released their fiscal Q2 report right after the bell on April 30th, and they absolutely crushed consensus with $111.2 billion in revenue.
Up 17% year over year.
Right. Their services sector hit an all-time high of $30.9 billion. And they're seeing this extraordinary demand for the new iPhone 17 lineup, the M4-powered iPad Air, and this highly anticipated MacBook Neo.
But the hardware sales weren't the real story here.
Not at all. The bombshell was the succession plan.
Yeah, Tim Cook officially announced he is stepping down as CEO on September 1st, 2026.
End of an era.
Truly. He's transitioning to executive chairman, and his named successor is John Turnus, the current senior vice president of hardware engineering.
Which is wild. I mean, in a world entirely obsessed with large language models, cloud computing, and software as a service, Apple is handing the keys to a $3 trillion empire to a hardware engineer.
A hardware guy.
Not a software executive, not a services guru, a hardware guy.
Yeah.
That is a massive counter-cyclical bet.
It really is, but if we look at the strategy, it makes perfect sense. By choosing a hardware engineer over a services or software executive, Apple is signaling that the physical device remains paramount. Well, the tech industry is currently pivoting from generative AI, a chatbot that just answers your questions, to agentic AI.
Right, these autonomous AI agents that can actually take actions on your behalf across different apps.
Exactly. Booking flights, moving money, organizing your calendar. The AI acts as an actual personal assistant executing tasks across your digital life.
Right.
But Apple's core thesis is that no matter how autonomous or intelligent the AI in the cloud becomes, it is entirely dependent on a physical portal to interact with the consumer.
Your phone, your watch, your MacBook Neo.
Exactly. These are the sensory organs of the AI. They're the cameras, the microphones, the screens. By elevating John Ternus, Apple is declaring that the physical hardware ecosystem is the ultimate bottleneck.
So whoever controls the premium physical device essentially controls the toll booth to the entire AI era.
That's their bet. They believe that owning the glass in your hand is the only way to effectively capture the value of all these new cloud services.
That makes perfect sense.
Yeah.
They don't necessarily need to build the best AI model in the world if they own the exclusive gateway to the user.
Right.
But I will say, it wasn't a purely triumphant earnings call. Apple actually flagged some very real systemic risks on the horizon.
Oh, yeah. They were very clear about the headwinds.
They explicitly warned about industry-wide supply constraints for advanced semiconductors. And they also noted intense, ongoing regulatory scrutiny from the European Union and the Department of Justice.
Which are massive operational hurdles.
Absolutely. So considering those massive headwinds, why authorize a $100 billion share repurchase and raise the dividend right now? I mean, during such a massive leadership and technological transition, is that just supreme confidence, or are they just keeping investors happy during a rocky handover?
Well, maintaining investor confidence is crucial right now. A $100 billion buyback acts as a massive shock absorber for the stock price.
Here's where it gets really interesting.
Yeah.
Because you don't build a $100 billion shock absorber unless you expect some serious bumps in the road.
Precisely. Apple's leadership is highly attuned to the fact that the broader economic foundation is showing serious cracks. The consumer might be buying iPhones today, but the structural integrity of the global economy is under severe stress.
And nowhere is that stress more visible than at the Federal Reserve.
Oh, absolutely.
Because on the exact same day that Wall Street was popping champagne over the S&P 500, the Federal Open Market Committee concluded its meeting. And they held the federal funds rate steady at a range of 3.5 to 3.75%.
Which sounds completely standard on the surface.
Right, but the actual voting record revealed the deepest policy fracture we've seen at the Fed since 1992.
It was essentially a mutiny.
A mutiny. You had Stephen Barron officially dissenting because he wanted an immediate 25 basis point rate cut. He cited a softening in labor demand.
Right.
But then on the complete opposite end of the spectrum, you had three regional Fed presidents, Beth Hammack, Neil Kashkari, and Lori Logan, dissenting against the committee's decision to maintain an easing bias.
Yeah, that is a huge split.
And just for you listening, an easing bias is basically Fed speak, meaning their official posture is that the next move in interest rates is more likely to be a cut rather than a hike. It's a signal to the market. But three presidents fundamentally rejected that signal.
Because they want the explicit flexibility to hike rates if inflation accelerates.
Right.
Neil Kashkari actually took the rare step of publishing a detailed public explanation of his dissent. His core argument is about unanchoring long-run inflation expectations.
Meaning people just get used to prices going up forever.
Exactly. Inflation has been elevated for nearly 6 years now. Kashkari is terrified that if consumers and businesses start to inherently believe that high inflation is just a permanent structural fact of life, it becomes a self-fulfilling prophecy.
Workers demand higher wages to compensate, businesses raise prices to cover the wages, and the cycle just locks in.
Exactly. And compounding all of this monetary tension is a massive leadership crisis at the Fed.
Right. Chair Jerome Powell is stepping down early on May 15th.
Yeah.
He's going to be replaced by Kevin Warsh, who has historically been a known proponent of lower rates, much more dovish.
Yeah.
But the wild twist here is that Powell isn't actually leaving the building.
No, he's not.
He announced he will remain on the Board of Governors as a rank-and-file member.
And this is where we need to be incredibly precise and impartial about the legal and political context documented in our sources.
Absolutely.
The Justice Department recently closed a criminal investigation into the Federal Reserve, though they explicitly noted the door remains open to restart it based on future referrals.
Right.
Concurrently, the incoming administration has been highly critical of the Fed's recent policy decisions. In his press conference, Powell stated that his unprecedented decision to stay on as a governor, essentially taking a massive demotion, is designed to ensure the institution can conduct monetary policy purely based on macroeconomic data, completely free from political interference from the administration.
And just to be crystal clear for you, the listener, we are absolutely not taking a political stance here between the administration and the Federal Reserve.
No, not at all.
We are simply reporting the historical friction exactly as it is documented in the source material.
Yeah.
But from a market perspective, this friction is terrifying. I mean, traders are circulating research notes comparing this to the 1940s analog.
Yeah, the 1940s analog.
Which isn't just a throwaway historical reference. It is a very specific structural fear about debt monetization.
It is the ultimate nightmare scenario for bond markets.
Can you break that down? What exactly happened in the 40s?
Sure. So during World War II and the immediate aftermath, the U.S. government obviously took on astronomical levels of debt to fund the war effort.
Right, massive deficits.
Exactly. And to keep the borrowing costs from literally bankrupting the government, the Treasury Department essentially forced the Federal Reserve to cap interest rates.
Wow.
The Fed was forced to buy government bonds to keep the yields artificially low. It's a practice known as yield curve control.
So they basically lost their independence.
Completely. The Fed became a tool for the Treasury to finance the national debt, even as post-war inflation rampant. And that subservience didn't end until the Treasury-Fed Accord of 1951.
So the fear today is that market participants think the Fed might be forced by the incoming administration to pin rates artificially low to monetize our current national debt despite high inflation.
That is exactly the fear. We have massive national deficits, sticky inflation, and a central bank facing intense pressure.
I mean, if you have one guy yelling cut rates and three people yelling, we might need to hike, and the outgoing chair is basically barricading himself in the building to protect institutional independence, how does the market look at this and say, everything is fine? It feels like the steering wheel is coming off the car.
Well, it explains why Powell looked so incredibly grim during that press conference.
Yeah, he did not look happy.
No.
Okay.
He explicitly admitted that inflation is misbehaving.
Misbehaving. That's an interesting word choice.
It is. He noted the Fed is positioned at the high end of neutral or perhaps mildly restrictive.
Which is central bank code for what exactly?
It translates to, we are tapping the brakes, the car is still speeding up, and we are terrified to press any harder. They have to wait and see.
And Powell knows exactly why inflation is misbehaving right now. Because the primary reason isn't happening in Washington, and it isn't happening in Silicon Valley.
No, it's happening in the Persian Gulf.
Exactly. So what does this all mean? We have to look at the massive geopolitical choke point happening right now. Because as of April 30th, 2026, the Strait of Hormuz, which is the most critical maritime choke point for global energy, is effectively closed.
Completely shut down.
Admiral Brad Cooper of CNTCOM issued a report stating that the current U.S. and allied blockade has successfully locked down 69 million barrels of Iranian oil.
Right.
And that freezes about $6 billion in hostile revenue. But the physics of the global oil trade are unforgiving. By closing the strait to contain Iran, we have simultaneously choked off 20% of the entire world's oil and gas supplies.
20%. The immediate market reaction was violently fast. Brent crude oil, the global benchmark, spiked overnight to $126 a barrel.
Good grief.
Yeah, before settling at a still punishing $114.
And this is the part that always trips people up, and I think it's vital to explain. Because a listener driving to work right now might be wondering, wait, the U.S. produces massive amounts of crude oil. If we're producing our own oil, why are we paying global premium prices? Shouldn't we have a home field advantage?
It's a great question, and it's one of the most misunderstood dynamics in global economics.
Right.
Yes, the U.S. extracts a tremendous amount of oil. We are practically energy independent on paper, but oil is a globally traded, highly fungible commodity.
Fungible meaning interchangeable.
Exactly.
Wow.
A barrel of oil from Texas and a barrel of oil from Saudi Arabia fundamentally serve the exact same purpose. Domestic prices do not exist in a vacuum. They are dictated by the global equilibrium of supply and demand.
Because the companies extracting oil in Texas are private businesses.
Right.
If the global price spikes to $114 because 20% of the world's supply is trapped in the Persian Gulf, the Texas oil company isn't going to sell their oil to a refinery in Ohio for $70 out of patriotism.
No, they're going to sell it at the global market clearing price.
Exactly.
When the Strait of Hormuz closes, countries in Asia and Europe that rely heavily on that Middle Eastern oil panic, they scramble to the global market, bidding up the price of every available barrel anywhere in the world, including the barrels pumped right here in the United States.
And that global premium flows directly downstream to the U.S. refinery and ultimately to the price you pay at the local pump. Gas is over $4 a gallon domestically.
Yep. And that energy shock is ripping right through the domestic macroeconomic data.
Oh, absolutely. The U.S. released its Q1 GDP growth, and it decelerated heavily to a sluggish 2.0%.
Which is not great.
Not at all. But at the same time, the employment cost index, which tracks wages and benefits, rose a very sticky 0.9%. Jobless claims are at their lowest point since 1969.
So we have this really toxic cocktail. Companies are hoarding workers because of demographic shortages, wages are staying elevated, energy inputs are skyrocketing, but actual economic growth is stalling out.
Which perfectly explains the sentiment reality gap we touched on at the very beginning.
Exactly.
Wall Street is celebrating corporate efficiency and hitting record highs. But Main Street is suffocating under sticky wage inflation.
Right.
I mean, core PCE is stuck at 3.2%. Fuel costs are through the roof. U.S. consumer sentiment fell 6.7% in April to its absolute lowest level since 1952.
1952.
Think about that. We've lived through the 1970s stagflation, the 2008 global financial crisis, the dot-com implosion, a global pandemic. And yet the American consumer feels worse today than they have in 74 years.
The physical reality of the working class is completely decoupling from the digital reality of the equity markets.
It really is.
And this strain is fracturing international markets as well. Look at the global ripple effects, specifically in Japan.
Oh, right, the currency intervention.
Yes. The Bank of Japan had to execute a brutal, desperate intervention in the currency markets just to prevent a total economic unraveling.
Because of the oil spike.
Exactly. Energy commodities are priced in U.S. dollars globally. So a weak Japanese yen means Japan effectively imports massive inflation every single time they buy a barrel of oil.
Wow.
The U.S. dollar to yen ratio hit a 2026 high of 160.70. The economic pain became so acute that Japan's Ministry of Finance literally had to issue final warnings to currency speculators.
Final warnings?
Yeah, they were aggressively dumping dollars and buying yen to artificially drag the ratio back below 156.50.
It is a cascading failure of global supply chains. A conflict in the Middle East forces the Bank of Japan to intervene in currency markets, which reverberates into U.S. Treasury yields, which hits the American consumer at the gas pump.
Everything is connected.
And this exact vulnerability to global supply chains is why the U.S. government is launching a massive legislative strike in the tech sector to secure future supply chains.
Right. Which brings us to the geotech wars.
Yes, the MACH Act. Congress just advanced the Multilateral Alignment of Technology Controls on Hardware Act.
The MATC Act.
Yeah. This is the government attempting to build an impenetrable fortress around the physical infrastructure of the AI economy. It is specifically targeting Chinese national champions in the semiconductor space.
Heavyweights like SMAC, Huawei, and YMTC.
Exactly. The act bans the sale and, crucially, the servicing of what the government classifies as choke point tools. The primary target here is DUV immersion photolithography.
Now, without getting bogged down in an engineering textbook, it is essential to understand why these specific machines are the target.
Please explain DUV.
So DUV stands for deep ultraviolet. These lithography machines are arguably the most complex pieces of mechanical engineering in human history.
Wow.
They use incredibly specialized lasers, bounced off flawless mirrors, shining through a layer of purified water to essentially print circuit patterns onto silicon wafers at the atomic level.
At the atomic level, that's insane.
It is. You simply cannot build advanced microchips, let alone AI chips, without these machines.
And the MKCH Act isn't just about stopping the sale of new machines to China. It targets the servicing of existing machines.
Right, which is the real kicker.
These lithography tools require constant daily calibration and replacement parts from the original manufacturers. If you ban the engineers from servicing them, the machines eventually just become multi-million-dollar paperweights.
And the U.S. is playing hardball to ensure this blockade holds globally.
Yeah, they are.
The MTCH Act includes a strict 150-day deadline for allied nations to completely harmonize their export controls with Washington.
And if they don't?
Well, if allies don't harmonize within 150 days, the legislation mandates that the U.S. will trigger the Foreign Direct Product Rule, or the FDPR.
The FDPR is the ultimate geopolitical hammer. It's an extraterritorial claim. It essentially dictates that even if a product is designed and manufactured entirely outside of the United States, say, a machine built in the Netherlands by a Dutch company, if that machine utilizes NUI U.S. origin software, blueprints, or even a single specialized American component in its creation.
The U.S. claims jurisdiction.
Right. The U.S. government claims the legal jurisdiction to dictate who that foreign company can sell it to.
And again, we must explicitly state to the listener that we are impartially outlining this debate. We are not endorsing either side.
Absolutely.
Proponents of the MTCH Act argue that this is a vital existential national security imperative. They believe that cutting off Chinese access to advanced semiconductors is the only way to stall their military modernization and AI capabilities.
But the critics call it protectionist industrial policy.
Right.
They argue that the blowback is severely damaging the U.S. economy.
Yeah.
And the critics have compelling, hard data on their side from semiconductor industry sources.
The financial hit has been massive.
It has. Previous rounds of export controls have already cost U.S. semiconductor suppliers roughly $130 billion in aggregate market cap.
$130 billion.
Yes. And this connects right back to the AI capex boom from Section 1. The U.S. is trying to build a walled garden around the physical infrastructure of AI. However, semiconductor companies typically reinvest about 18 cents of every single dollar of revenue straight back into research and development.
That R&D loop is everything.
It's what keeps American technology ahead of the curve. If Washington abruptly cuts off billions of dollars in foreign revenue streams, they are simultaneously removing vital R&D funds that created this technological dominance in the first place.
It is a massive gamble. The U.S. is hoping that starting adversaries won't accidentally starve domestic innovation.
But while Washington is focused on building walls and restricting trade, the private sector is focused on literally escaping the planet to build new frontiers.
Oh, the SpaceX news.
Yes. Meanwhile, in the private sector, the financial markets are currently being dominated by the leaked news that SpaceX has confidentially filed for an IPO.
And the numbers are just earth-shattering.
They're targeting a public valuation of between $1.75 trillion and $2 trillion.
$2 trillion. To put that into perspective, a $2 trillion valuation puts SpaceX in the rarefied air of Apple, Microsoft, and NVIDIA.
It's unbelievable.
And to justify that valuation, they are executing a massive structural pivot. They are no longer pitching themselves to institutional investors as merely an aerospace company launching rockets.
Right.
They're pitching themselves as the ultimate aerospace and AI infrastructure giant.
And they are backing up that pivot with incredibly aggressive M&A activity. SpaceX is acquiring an AI coding and software company called Cursor for an unbelievable $60 billion.
$60 billion for a software company.
Yes, and they are so desperate to close this deal that they have agreed to a $10 billion breakup fee if it falls through. But I have to push back on this. SpaceX is buying a terrestrial software company for $60 billion to justify a $2 trillion aerospace valuation.
It sounds a bit crazy.
Are they actually building rockets, or are they just building a giant tech ETF in space to maximize their IPO payout?
Well, if we connect this to the bigger picture, it's actually about securing the absolute extreme end of the AI capital expenditure cycle we discussed earlier.
The infrastructure build-out.
Exactly. Think about the massive capex numbers Microsoft and Meta are throwing around. Hundreds of billions of dollars. SpaceX is targeting a massive capital raise of $50 billion to $75 billion in this IPO alone.
Wow.
They represent the ultimate test of the market's appetite for AI-boosted private infrastructure. SpaceX is signaling to the market, we need hyperscaler levels of cash because we're building the physical infrastructure of the future in low Earth orbit.
And Wall Street is so desperate to get a piece of that massive infrastructure play that the financial institutions are actively bending over backward.
They're literally changing the rules of finance to make it happen.
Yeah. The S&P Dow Jones Indices is currently considering rewriting their foundational rules to fast-track mega-cap companies like SpaceX into the S&P 500.
Which is unprecedented.
Historically, to get into the S&P 500, a company needed a proven history of positive GAAP net income. They had to prove they were actually profitable.
Right, you couldn't just burn cash forever.
But now, the index providers are considering waiving that profitability requirement for these massive high-growth entities so they can jam them into the index after just 6 months of being public.
It just reflects the sheer, undeniable gravitational pull of these mega-cap technology and infrastructure companies. Analysts are referring to it as the computational supercycle.
The computational supercycle. That phrase perfectly distills the absolute paradox of April 30, 2026.
It really does. The world is relying on this computational supercycle, this incredible engine of artificial intelligence, massive capex spending, and sheer computational power to outrun geopolitical gravity and physical energy constraints.
Wall Street is making a multi-trillion-dollar bet that the digital economy can successfully decouple from the physical constraints of the legacy economy.
But as we've unpacked today, the cloud is incredibly heavy. It is bound by the laws of physics.
It needs Caterpillar diesel generators.
It requires massive baseload power.
It needs physical chips manufactured by irreplaceable DUV lithography machines, which are totally vulnerable to geopolitical blockades.
And it operates in a world where a conflict in the Strait of Hormuz can send the price of Brent crude skyrocketing, crushing the very consumers who are supposed to be buying these new AI-powered devices.
And that brings us back to you, the listener.
Because why does this matter to you? Well, whether you are investing in your 401k or just wincing as you pump $4 a gallon gas into your car, you are caught directly in the crossfire of this economic tug of war. On one side, you have the high-tech deflationary promise of AI efficiency, and on the other, you have brutal physical world inflation driven by energy wars and supply chain decoupling.
It is the neighborhood block party happening right next to the five-alarm fire. And right now, we're all just standing on the street corner, feeling the heat, watching both of them burn, and wondering which reality is going to consume the other.
It's a precarious moment.
It really is. Before we wrap up today's deep dive, we want to leave you with a final provocative thought to ponder on your own, building on what we just discussed about the shifting rules of the market.
Think about the S&P 500. If index providers actually rewrite the rules to allow massive, unprofitable growth megacaps like SpaceX into the S&P 500 after just 6 months, does the S&P 500 stop being a mirror of the actual American economy?
Does it simply become the world's largest publicly traded venture capital fund?
And if so, what does that mean for your retirement account? How much risk are you actually holding when you buy a supposedly safe index fund?
It's a critical question worth asking the next time you look at your portfolio in this brave new macroeconomic world. Thanks so much for joining us on this journey through the data. We'll be back next time to unpack whatever comes next. Until then, keep digging.